Ladies and gentlemen, good day and welcome to Lumax Industries Limited Q4 FY23 earnings conference call. This conference call may contain forward-looking statements about the company which are based on the beliefs, opinions and expectations of the company as on date of this call. These statements are not the guarantees of future performance and involves risks and uncertainties that are difficult to predict. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touch-tone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Deepak Jain, Chairman and Managing Director of Lumax Industries Limited. Thank you, and over to you.
A very good morning to everyone, and I hope everyone's doing well. Along with me on this call, I have Mr. Anmol Jain, the Joint Managing Director, Mr. Vishnu Johri, the CEO, Mr. Sanjay Officer, along with Mr. Ravi Teltia, the CFO of the company, Ankit Thakral from Corporate Finance, Mr. Naval Khanna as the Corporate Head Taxation, and Priyanka Sharma, the Head Corporate Communication. We also do have SGA, Investor Relation Advisors, on this call. The results and investor presentation were uploaded on the stock exchange and the company's website, and I do hope everybody has had an opportunity to go through the same. I would like to begin by giving some insights on the economy, followed by the current scenario in the auto industry and business. For over a decade, India has been one of the most prominent and robust economic growth. On the back of the government measures to develop transportation infrastructure, logistics, and the business ecosystem, it is anticipated that the GDP will expand to 6.5% in FY2024, making it one of the fastest growing major economies in the world. Talking about the auto industry, India has emerged as one of the most preferred locations in the world for manufacturing high-quality auto components and vehicles of all kinds, narrowing its gap over several established locations in the process. The auto industry is one of the primary economic pillars and also a vital growth driver due to its strong backward and forward linkages. Liberalization and deliberate policy interventions has produced a vibrant competitive market and attracted several new players, resulting in expansion of auto industry, production capacity and capability. India is now the third largest automotive market in terms of fast cars. This increase in demand for automobiles has in turn led to growth in demand for auto components in the country. FY23 began with the world witnessing a major war between two countries which caused supply chain disruptions. However, prices are moderated over the past year due to more efficient management of supply chains and greater availabilities of commodities. Favorable policy initiatives such as the impact of the new PLI schemes, reassuring pronouncements in the budget, forward-thinking logistics and foreign trade policies, and the recently announced lowering of CNG prices would augment well in supporting the industry's growth. The industry is expected to grow by a high single digit in FY24 despite global headwinds, largely due to a robust domestic environment and also the OEMs seeking high-quality auto components to meet major customer demands for more sophisticated and unique vehicles, as we see that there is a progression of the vehicle industry going more into the premiumized section, SUV segmentation, and largely having more of volume and value on the vehicles. After a 2-year hiatus, FY23 was the first full year without any impact from COVID. Consequently, aggregate retail auto sales increased over the course of the year. Except for tractors, all other categories experienced double-digit growth. However, I would like to note that tractors had been performing consistently well over the last 2 years. PV segment, of course, as I mentioned before, is seeing a premiumization. A lot of customers are preferring SUVs compared to sedans. The sale numbers for PV are on all-time high, surpassing the previous high of the year 18-19. On the EV front, India has the potential to be one of the largest manufacturers thanks to the opportunity that the segment has facilitated by good policy intervention both at center and state. The imminent expansion of the EV market is already attracting high investments. The growth of EV will be led by 2- and 3-wheeler. However, we do notice a good trend in the 4-wheeler as well, where a lot of the major players are going to launch their EV models. Entering into FY24, we expect the growth momentum to continue after the robust demand seen in FY23, supported by favorable demand sentiments and various government initiatives for rural and urban development. We also see that FY23 is a run-up to the general election scheduled in FY24, and usually there is a high consumerism based on the big push by the governments at the center levels. With the high opportunities in the EV market, premiumization of vehicles, and changes in the regulatory environment, it will be proving to be key growth drivers for the automotive industry. With Lumax Industries being a market leader in the lighting segment, we are all set to outgrow the market and increase the market share as well. I am happy to share that your company has a healthy confirmed order book of around 1,300 crores. 85 to 90% of it is new business, and out of which 40% is from the EV models. With this, I would now hand over the call to Mr. Sanjay Mehta, Group CFO, to update you on the operational and financial performance of the company.
Good morning, everyone. I will take you through the operational and financial performance for financial year 23. The share of LED lighting for the year stands at 35% and conventional lighting at 65%. With respect to segment mix, FY23 as a percentage to revenue, 67% is from passenger vehicles, 27% from two-wheelers, and 7% from commercial vehicles. With respect to product mix, of the total revenue, 66% of revenue is from the front lighting, 25% from rear lighting, and 9% is from others. On financial performance, I am delighted to say that Q4 FY23, the company had its strong performance with quarterly revenue standing at 608 crores, depicting a growth of 11% on year-on-year basis. Revenue for FY23 stood at 2,320 crores as against 1,751 crores, witnessing a stellar growth of 32%. Revenue for Q4 from manufacturing business grew by 17%, and for FY23 it is grown by 34% year-on-year basis. The company reported consolidated EBITDA of 222 crores with a margin of 9.6% in FY23 as against 148 crores in FY22, a growth of 50%. In Q4 FY23, the EBITDA stood at 53 crores with a margin of 8.8%. EBITDA for Q4 degrew by 12% from Q4 22 due to increase in RM cost on account of product mix change and increase in other expenses. EBITDA was also impacted due to decrease in mold business profitability due to the deferment of tooling sales to the next year. PBT before exceptional expenses and share of associates is rupees 24 crores in Q4 FY23 against 39 crores in the corresponding quarter last year. The profit after tax stood at rupees 21 crores in Q4 versus 29 crores in Q4 last year. For FY23, the PAT is at 103 crores as against 41 crores in FY22, registering a growth of 153%. The capex incurred during FY23 is 136 crores, which includes 33 crores on account of leasehold assets. So actual capex outlay is 103 crores. The greenfield project at Pune is as per schedule and production is expected to commence in Q3 of the current financial year. With this, we can open the floor for question and answer.
Thank you. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touch-tone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question comes from the line of Ashin Modi from Equirus. Please go ahead.
Yeah, thanks for the opportunity. So my first question is on the margins during the quarter. So the margins were missed because of gross margin. So could you please explain that what was the impact of higher mold sales on margin, and ex of mold sales, what would have been a normalized margin?
So margin in Q4 on the mold is around 17%. If correspondingly I will take Q4 of 22, it was 26%, largely because of the deferment of the mold sales to the next financial year.
And so could you explain why the margin declined quarter on quarter?
On the mold sales?
No, overall margin.
Overall, because of, As mentioned, 0.5% and because of the product mix, RM is higher by 0.5% around, and there is increase in other expenses also, but that is in the PBT level.
Okay. So what sort of a gross margin do we see going forward, sir?
So Q4 23 gross margin was almost around, I think the RMC is 65, so gross margin was 35%. I think it will be improved way forward in the Q2 at least. Because whatever the higher cost inventory is there, it will be, I mean by June or July it will be spread up, and I think Q2 onwards the margin will go in upward way.
And so my next question is on this profit from associate. That number is, coming pretty strongly in the last 2-3 quarters. So what sort of a profit of SL Lumax do we expect in the next year?
So as mentioned in the past also, SL Lumax is serving our Korean customers. This year they have reported the EBITDA margin of around 13%. But because we are having that around 21.86% of equity, it varies on the customer basis. So in fact we are not...
I think so, Jayant here. I think as you know, Hyundai has been basically having a good performance, and we expect them to sustain the margins as what they've been doing with a good top line growth as well this year. So Hyundai and Kia both are performing well, and this joint venture of ours, 100% basically dedicated with basically as a single source supplier.
Okay. And sir, my next question is on the order book side. So our order book is growing strongly every quarter. So what sort of a ramp up do we see of this order book in the next 1, 2, 3 years?
So this is Anmol Jain. So out of the 1300 crores order book, the peak would come in FY24-25. Almost close to 60% of the revenue would come into revenue stream in FY25. FY24, I would say only about 10% to 15% of this would be seen.
Okay. And sir, on the customer side, sir, I had questions on M&M and MG. So MG has grown pretty strongly for us in the last year. So what sort of business do we have from MG, and what sort of a growth do we see with MG?
So I think MG, as we mentioned, will continue to grow. I think we did get a certain order of MG which was fructified in FY23, and that's the reason you see a significant growth, I believe almost to the tune of 73 crores on a year-on-year basis, which we grew on MG Motors, but we expect this momentum to continue in FY24.
Okay. And so this XUV 700 supply which we reported last year, so it will start from Q2, and what sort of a business do we expect? What sort of addition do we expect from new models or new business with M&M?
So the XUV 700 supplies will start, as Mr. Sanjay Mehta said, with the start of the new facility in Chakan, which is expected in Q3. So we will get about 6 months of that revenue for the current fiscal year. But Mahindra, as a customer, we continue to be very bullish upon, and I think we expect a strong growth with Mahindra even in FY24 as a customer.
Okay. Thanks a lot, sir. I'll join back with you.
Thank you.
Thank you. Before we take the next question, a reminder to all the participants that you may press star and 1 to ask a question. Next question comes from the line of Saumil Shah from Paras Investments. Please go ahead.
Hi, sir. I wanted to ask, what is the reason for closure of Gurugram plant, and what will be the impact of that?
So the reason is very simple. Number one, it was a plant which was set up in the late mid-80s. So in terms of the technology, in terms of the space, in terms of the infrastructure, it does not support the new technology lamps, and that's the reason we moved all the business to one of our current facilities in the NCR region. Number two also was the cost of the manpower. There was a significant cost associated with the blue collar, and we've been able to service the same business now at a, let's say, much lesser cost by moving the business. So that was primarily as a part of a consolidation strategy. We decided to close the Gurugram premises.
So basically that won't have any impact on our sales, right, on the revenue side?
Not at all. The business was, as I said, all moved to another current facility, and the customers were informed, and the revenue stays intact. No loss of revenue.
Okay. Okay. And so usually our second half is much better than the first half, right? And that is what you also mentioned in the previous call. But this year, I mean, what went wrong this time? We don't see much of a growth in the second half compared to the first half.
In terms of revenue?
Yeah, revenue.
I think primarily the certain OEMs have had certain issues in Q4 specifically in terms of growth. Even if you were to look at the industry performance in quarter 4, if you look at the passenger car, it's been kind of muted. So if you look at Q3 to Q4, it's just about 10% growth, but two-wheelers also in quarter 4 have had a degrowth as an industry. And again, that was one of the primary reasons in Q4, traditionally where the revenue is very high, you've seen a little bit of a more muted revenue. But I think this is a temporary phenomenon. We have seen certain good bounce back in quarter 1 as well. So I think in FY24, we continue to be very bullish on the overall growth for the company.
Okay. And so last year our revenue grew by almost, say, 35%. So can we continue similar growth in current year, or what would be a ballpark number or some guidance?
So I would say that the current year the growth would be not high as 35%, but I would say it would be more like 20 to 25% would be something which we should be looking at. This would be a combination of the volume growth as well as certain value growth because of technological changes in the lighting.
Okay. So with that, even our EBITDA margin will improve. That's what you want to say?
Absolutely. I think not just because of revenue, but I think also because of scale and economies of scale, we will definitely, our focus would be to continuously improve our EBITDA margins.
And any guidance on the EBITDA margin for this year?
I think I've always maintained a double-digit EBITDA margin is something which we do envisage. Again, we are pretty confident that we should be in the double-digit space for the current year.
Okay. Okay. And so last question from my side. Any capex plans for this year?
Yes, absolutely. Last year it was about 135 crores, as Mr. Sanjay Mehta explained. This year, from a current facilities, maintenance capex, etc., will probably be a similar number, about 135 crores. But I think there is also a 175 crores outlay for the greenfield Chakan facility, which I had mentioned earlier. So that continues to be on track. So total outlay would be give or take about 300 crores, including the greenfield facility of Chakan.
So this will be for the current financial year?
That's correct. This all would be capitalized in FY24 to service the order book all the way till FY25, FY26. And on this current order book, the investments we are making, the asset turnover would be significantly higher than the asset turns the company enjoys today.
So in terms of debt, that will increase our debt, or how are we going to fund these capex? From any internal accruals, or how is it?
No, the debt will increase because this new Pune plant, we are going to be funded to the long-term debt of almost around 150 crores. Right now, the long-term debt is around 80 crores, so debt will be increased by almost around. The debt equity ratio at present is 0.16. It will going to be almost around 0.3 or 0.32%. That's it.
Okay. Okay. Fine. Thank you very much. That's it from my side.
Thank you.
Thank you. Before we take the next question, a reminder to all the participants that you may press star and 1 to ask a question. Next question comes from the line of Prolin Nandu from Chiebo. Please go ahead.
Yeah, hi sir. Couple of questions from my side. First is on margin. While we understand your reasoning for a low margin this quarter, but we have always, mentioned that double digit is something which we aspire, and in this year also 2 quarters we had double digit, 2 quarters we had lower than that number. So I mean, I understand the drags to the margins, but some of the benefits in terms of operating leverage, some of the benefits of having a PCB plant in-house are somehow not visible, or there is a lot of volatility in the numbers. So, and again, you mentioned that maybe we can expect double-digit margins improvement from Q2 onwards. So again, Q1 would, I assume, be a lower than double-digit kind of a margin. So, I mean, what is it that is not leading us to achieve that double-digit kind of margins? And in the past also calls we have discussed that is our aspiration. We look at some of the global players; they too are at not just double-digit, but slightly mid-teens kind of margins. So why is that consistency not being shown in our performance?
I think there are 2-3 aspects. Number one, clearly the tooling which Mr. Mehta mentioned, that is something which hugely differs. Overall, as a company, we continue to maintain a similar margin on an annualized basis, but because the tooling is not the same on all programs in terms of the margins, there are, in certain quarters we get a better tooling advantage, and in certain quarters we do not get that tooling advantage. So that is one reason why on a quarter to quarter you see a variation of the overall margins because of tooling. Second, specifically in quarter 4, there was a raw material consumption which, if you see, has gone up because of certain design changes on certain inventory. We are still in the process of discussing with our customers to get certain compensation for those changes. But if those would probably be coming in quarter 2, not quarter 1. So those were fundamentally 2 reasons, and I think we had certain operational inefficiencies which now have been fixed, which was a specific one-off case in quarter 4, but countermeasures were taken and those have been restored. So as I said, in FY24 we are a lot confident that we will be able to not just get into the double-digit space, but definitely outperform our historic performance in terms of the margins as well. You're right, in terms of revenue, I think we have seen a 35% growth. Some of that has definitely come in terms of the operating leverage, but again, I think the loss was on account of the raw material consumption because of the product mix and because of this one-off case in quarter 4. We do expect that to stabilize in quarter 1, quarter 2 for FY24, and even on a 20 to 25% growth, which I had mentioned, I think we will be able to see a significantly higher growth at a profit margin level in terms of absolute amount.
Thank you, sir. That's very clear. The second question is on your gross block. If I look at your gross block addition from FY19 to FY23, there is a 463 crores gross block addition. I am talking about standalone basis. The sales is 671 crores incremental sales. Asset turns on a gross block basis is 1.4x. So I just wanted to understand that how much of this gross block addition is something like a maintenance capex, PCB, and how much is the actual capacity addition, right? So I mean, on a 1500 crores of gross block, what can be the top line that we can assume if we don't do any incremental capex?
So the capex is on multiple aspects. Number one, there is a lot of capex which also goes into the engineering and product engineering, which is pretty much required to service the order book. It has nothing to do with the capacity. There is certain brownfield maintenance capex, which is kind of recurring every year. I don't believe we have done any significant greenfield expansions in the last 4 to 5 years. We've done some Sanand plant as a brownfield, but again, SMT was one of the major investments out of this give or take 500 crores gross block expansion from FY19 to FY23. You're absolutely right. The current asset turns as on 31st March sits at about 1.5. However, as I mentioned briefly earlier, the 1300 crore order book, we do envisage maybe perhaps an investment which will be giving us a asset turn of about 2.5 to 2.6 for this specific order book. And that's the reason that in the next foreseeable future, we expect the asset turns of the company overall to improve from the current 1.5 to at least around 2, because the order book is come at a much healthier asset turns It's a higher value contribution. As was mentioned earlier, there was a large part of it was LED, almost more than 90-95% of the order book is on LED lamps, which has a higher value contribution. So the asset turns, definitely in the next 2 years, you will see a significant improvement vis-a-vis where we are currently.
Sure, sir. So, I mean, is it fair to assume that right now, whatever our gross block is of 1,500 crores and the sales of 2,300 odd crores, that's an optimal level? There can't be any improvement in our core gross block to asset turn kind of ratios. Is that a fair assumption to make?
I won't necessarily say so, and again, I don't want to get into the micro, but when we talk about the overall, you're looking at overall revenue, but a lot of the shifts happen based on the regional capacities. So while we are putting up a plant in Chakan, that's basically because the region numbers are growing. At the same time, certain new orders which will be going, and we will internally be moving capacities from Gujarat to Chakan to make space for new capacities and new models which will be coming into Gujarat. So regional capacities would hugely vary. North, for example, we are still sitting on some idle capacities. But overall, obviously, if you start seeing the revenue, I would still say that there is a upside of maybe about 10 to 20% on the revenue based on the current gross block.
Sure. So sorry to probably harp on this point a little bit further. Just wanted to understand the capital intensity in our business, right? In some sense, we have a capacity. We still are, only 35% LED, 65% is still CFL. So there is a CFL capacity which will move to LED, and then again that will not add to our incremental revenue. Then our client shift, right, which also does not add to incremental revenue. So I mean, on a core business quality or capital intensity basis, is this a very high capital intensive business where we'll have to change according to what the customer wants and according to the trend of moving from CFL to LED? And there would always be a very high maintenance capex in our books. I mean, is that a fair conclusion to make based on your remarks?
Not necessarily. Number one, it's not CFL, it's halogen. Number two, there are always going to be certain brownfield and certain maintenance capex, which I would say for this company historically around maybe 70 to 80 crore rupees have gone in every year on a maintenance capex. We've also invested significant money in the R&D in the last few years, which is the result of why we're sitting on a 1,300 crore order book today. But I do believe that there would be certain this one greenfield and maybe another brownfield expansion, which we may see in the foreseeable future to meet this order book. Apart from that, I think we are not going to be significantly investing in any other capacity expansions in any other region. I think we will be having surplus capacities to meet the FY26, FY27 order books. But apart from that, we don't see any large investment on capex.
Sure, sir. Can I push for one more question if that's fine with you?
Sure, go ahead.
Yeah. So in the past, we had, for whatever reason, missed out on orders from Maruti for some of their blockbuster models. Now, in Mahindra also, we were not the first mover in XUV 700, but we got into it later. So what prevented us from getting into some of these models for Maruti at a later date as well, right? In some sense, although we did not move, we did not have that first mover advantage. But was it something that came from an OEM and they had some limitation in terms of how much they wanted to give out to us, or was it something at our end because of which we missed out on that?
No, so it's not a matter of miss out. Actually, you're saying it from a hindsight point of view. So let's rewind basically about 5 years back. Say where Lumax was catering to A segment, B segment, 100%. What basically happened is when the RFQs were coming in, I'm particularly talking about Maruti Suzuki, when you used about the blockbuster like a Brezza or something like that, their RFQ volumes are extremely limited. And I think Maruti as a sourcing decides at how much market share they want to continue and keep because they have multiple suppliers. Based on the conversations, they basically make a sourcing strategy. Well, I don't think anyone would have envisaged this kind of a very strong shift which basically happened in the past car, especially from A, B segments to actually a premium SUV kind of a segment. And this is a continuation of a trend which always continues. In lighting, it almost takes about 3 years to develop any models. And hence, I think when we could not basically get into the Maruti strategy because of their redistribution of volumes, they were also not expecting such a change on certain launches where it was from RFQ to actually the product launch and market share. It was a very different thing. Similar trend happening in Mahindra, you saw similar trends happening in Tata. I think from a Lumax perspective, we are very clear. There are few customers which we would like to have a bigger stake in and continue to strive for a higher wallet share. Even going forward, we do feel that SUVs premiumization will continue. This is actually also fast-tracking their technology trend. So going forward, Maruti, Mahindra, companies like Tata, MG, they will continue, and if you see, they are in our top 5 basically customer list. I just want to also add here that, if you look at from an EV perspective as well, and I think we did mention in the call that 40% of the new orders are EV. If I were to break down the new order book, I think 85% of that EV order book is actually from the passenger car segment. So we are actually pushing basically clearly where we are going for market trends where, let's say, a Suzuki business on EV or a Mahindra business on EV, we want to basically grab that. Suzuki and Mahindra both have been actually late movers in EV, but we do believe with the new product mix coming in, it will actually give us also good volumes and both value. So this is basically the strategy in play, and I think it will basically be dynamic based on the market trends and market shifts.
Sure, sir. That's it from my side. Thanks a lot and all the best.
Thank you.
Thank you. Before we take the next question, a reminder to all the participants that you may press star and 1 to ask a question. Next question comes from the line of Abhishek from Dolat Capital. Please go ahead.
Good morning, sir. Sir, despite a slowdown in two-wheelers, revenue growth was impressive, around 30% Y-on-Y in FY23. So can you explain the key driver of this growth and how is the share of business with the different OEMs?
Sorry, can you please repeat the question one more time?
Sir, in a two-wheeler space, revenue growth was quite impressive, 30% Y-on-Y in FY23. So can you explain what are the key drivers for this growth and how is the share of business with the different OEMs in two-wheelers?
I think the 3 key customers for us in two-wheeler segment which have grown on FY23 vis-a-vis FY22 are clearly HMSI, where we've seen almost a 25% growth. TVS, which was a new customer, which also has seen a 25% growth. Now, the customers, they may not have grown as much, but because we've been able to get into certain models, and those models have fared well, or even in TVS, we've got a full annual year volume. So we've grown by 25% in TVS, and also Hero, we also grew by almost close to 22%. So these are the 3 key customers because of which the two-wheeler segment grew. And again, the volume of this is probably in line with customer growth, but I think there is also an incremental growth which has come from the value.
And how much revenue from the EVs in two-wheeler space?
EV two-wheeler space, the revenues are negligible or probably close to almost nothing because we still have just one EV two-wheeler customer, which is still in the development stage.
Okay. So is there increase in the content per vehicles in EV side in the two-wheeler space?
Sorry, can you repeat that, Abhishek? Your mic is not very clear.
So is there increase in the content per vehicles in EVs versus ICE?
The increase on the vehicle is fine, but right now, if you look at the EV space and the two-wheeler, it's still negligible. And that's really a space where, we feel that the pricing is not something which is significant. The EV makers are a little skeptical of giving retooling and design costs as well. So that's something which we are watching out for, but we are not completely bullish. Rather, we are spending more resources in securing the passenger car EV models, where there is a higher contribution, a higher value addition, and there is a significant technology leap forward. So that's our strategy on the EV front, that we will prefer to go through the passenger car segment, not just the two-wheelers.
Abhishek, I would just like to add one more thing, and if we mentioned that in the prior calls as well. I think with so much EV two-wheeler proliferation. Of course, the government also, both at state and basically center, has given subsidies. You can see that right now there is the leaders in the EV space are having some concerns on basically the same subsidy because the business model is actually on a subsidized model. Lighting is actually powertrain agnostic. So irrespective of EV or ICE, you'll continue to do with lighting. However, on a two-wheeler, the trend will continue to basically adopt more EVs. We are pretty much bullish on basically the players who are, you want to call them the legacy players or the already established players, where we see the Bajaj, the TVS, the Heroes and the HMSI, when they would be actually putting their manufacturing footprints on EVs and launching models, we would like to have those models particularly, and one or two basically EV new age players where we actually are trying to make inroads. But I think that is where we are coming in. We don't want to just continue to supply to each and every EV two-wheeler player. As of now, we are watchful also of their basically production plans and their performances.
Okay, sir. And sir, in Chakan plant, it will be commissioned in two phases. So when Chakan plant will be commissioned, first phase, and how much incremental revenue will come from that plant?
As I had mentioned before, the phase 1 we will start in Q3 of FY24, the SOP. Again, the capacity would be about 500,000 vehicle sets. The investment outlay I have already mentioned for phase 1 would be about 175 crores, primarily catering to Mahindra and Tata Motors. The incremental revenue would be close to around 450 odd crores, which will probably come in full year FY25 from this phase 1.
Okay. And this 450 crores incremental revenue, that will be in two phases or it's only on one phase?
This is all I'm talking about phase 1. So the phase 1 investment, the phase 1 capacity, and the phase 1 revenue. And when I said 450, this is the incremental revenue. The plant revenue would be slightly higher, but that would be a replacement or a shifting of business from one plant to the other. So this is all phase 1. I am not yet talking about phase 2, which will probably be around FY26 onwards in terms of revenue stream.
Okay, sir. And my last question is related with this forex loss or gain in FY23. What was the number, sir?
2.2. It's 2.2 forex loss.
And that was added in other, that was included in other income?
Yes, other expense because it is a loss.
Okay, sir. Thank you. That's all from me.
Thank you. Next question comes from the line of Alisha Mahavla from Envision Capital. Please go ahead.
Hi, sir. Good morning. Thank you for taking my question. So we have done capex at the Bawal plant, which was supposed to be a sort of backward integration to aid gross margin expansion, but we're yet to see full benefits of that. And the previous calls, we also mentioned that there's some incremental capex that we were planning to do at Bawal. Can you just give us an update on that?
Sure. So we did invest in Bawal plant. You're absolutely right for backward integration of the electronics. We've still not got a full, let's say, the gross margin expansion on account of that. But I think in FY24, a large chunk of it would be fully utilized. We are still in the electronics facility. We were still having a bit of outsourcing versus insourcing. So in FY24, you will start seeing the benefit of the backward integration of electronics for sure. Apart from that, as I mentioned, the FY24, there is a 20-25% growth on the top line, which will further bring in operational efficiencies and add to the margins, operating margins.
Just two follow-up questions here. One, I believe that this plant was started somewhere in FY20. We're in FY23 and we're yet to see full benefits of it. So what has led to this delay apart from the COVID-related one-year delay? And the 20-25% growth we're talking about, with the 1,300 crore order book, we're expecting only 10% revenues to come in FY24. So can you help me understand 20
across a few customers, and also full year benefit of certain models which were launched in FY23, probably towards the H2 in quarter 3 and quarter 4. So we will realize the full year annual volumes of those models. Those were the reasons why the remaining 10 to 15% growth is coming from. Number 2, on the SMT electronics, you're right, FY20 when we started the facility, again, if you see FY20 to 21, there was a dip in the revenue as well because of COVID, and that's one of the reasons why we were not able to realize the full potential of this. Post that, we have had a ramp up in FY22 and as well as in FY23, and if you see in FY23, there is a slight expansion on the margins, but going forward in FY24, we should be able to get the whole electronics benefit. Now, electronics also has 2 parts. While there is a benefit on electronics per se, which is more internally captured, there are certain other parts also because of certain price changes which impact the raw material consumption. So even though electronics would have contributed to our internal margin expansions, but there are other reasons which have actually led that incremental benefit get neutralized. So it's not necessarily true that we've not been able to get the benefit by backward integrating the electronics within the company, but you don't see it in numbers because there are other reasons which have kind of neutralized that effect.
I understand this was one of the key pillars that would aid us to reach the double-digit margin that we're aspiring for, and hence the clarification.
Sure.
Okay. Also,
yeah.
And just one last question. The tax rate for the year is about 30%. Any reason for the higher tax rate? What is the expected ETR?
Because of the deferred tax, the equivalent tax is there, so actual tax is 32.6 precisely.
Sorry, I couldn't hear that.
Because of the deferred tax, because the tax is both normal tax and the deferred tax, so it comes to 32.6 for the full year, and for the Q4 it is 38%.
Going forward, can we expect normal tax?
It will remain in tax around 32 to 33%, at least in the next year.
In the next year? Hello?
So the follow-up on the below statement is that we have not opted for the 25% tax regime as of now because of the MAT credit available in Lumax Industries, which will be continued till next year.
Okay, got it. Great. Thank you.
It will be around 33%.
Thank you. Next question comes from the line of Rahul from Art Investments. Please go ahead.
Yeah, thanks for taking my question. So if you look at SL Lumax, that seems to work at a 13% margin, which is significantly higher than ours. So what explains this gap and what needs to happen for that gap to be bridged?
Well, actually, Rahul, SL Lumax and Lumax Industries would not be a very comparable kind of situation. It operates out of one location. It operates out of one customer. Pricing is basically delivered fundamentally in Korea. It's right now at a 13%. Historically, it has not been only just doing at 13%. It has also basically been doing at a higher, lower as well. It's been even at 6%, 7%. Those are also things. So I think it's a very, very symbiotic relationship which SL enjoys with Hyundai. And I think we continue to do it as Hyundai has also been now, along with Kia, been growing the market. There are further economies of scale, and that's how basically they've been able to maintain this. So at least for next year, we see that this basically gets maintained. Of course, it all depends on the Hyundai Korea strategy in terms of purchase.
Understood. Thank you. And secondly, if I may ask, your ex-CEO seems to have moved to a competitor on the two-wheeler side. Should we read that as an indication from that company to get more aggressive on the four-wheeler side?
Well, we do not comment on ex-employees. I may say we wish him all the very best in his future career endeavors.
Okay, thank you.
Thank you. Next question comes from the line of Somil Shah from Paras Investments. Please go ahead.
Thanks for allowing me a follow-up question. Just wanted to understand, you did mention 20-25% revenue growth, but what would be the impact on bottom line? Can we expect even higher than 25% growth in bottom line?
Yes, absolutely. I think that's the only way the margins will expand, right? So when I mentioned that the margin expansion will take place, then clearly the operating margins and the bottom line will grow at a much faster and a much greater rate as the top line. So yes, we do expect a profit expansion of greater than 25% for FY24.
Okay. Any ballpark guidance number for bottom line?
We would like to get into the double digit for sure, and would like to sustain that. I won't be able to give you an exact number, but definitely, if you see historically, we've operated at a 10 to 11% band of operating margins, EBITDA levels. Definitely, our endeavor is to achieve and maybe perhaps even surpass that bandwidth in FY24.
Okay. Because we are doing a capex of say 300 plus crore, so that will increase our debt also, and that will in turn increase our interest cost and depreciation. So just that's why we were asking this question. Yeah.
And hence I'm focusing on EBITDA, not PBT. I think EBITDA is the right measure to be focused at. And when I talked about double digits and when I talked about 10 to 11% margin in the past, it was always at EBITDA level. So yes, we will get back into double digit space and perhaps surpass our historic margins as well at EBITDA level.
Okay. But bottom line also you can surpass 25%. That is compared to the previous years.
Sure.
Okay. Okay. Thank you very much.
Thank you.
Thank you. Ladies and gentlemen, we have reached the end of question and answer session. I would now like to hand the conference over to the management for closing comments.
Well, I would like to thank everyone for joining on the call. We continue to remain confident and buoyant on the growing prospects of India and the automotive sector. I hope we've been able to respond to your queries adequately, and for further information, kindly request to get in touch with SG, our relationship advisors. Thank you and stay safe.
Thank you. On behalf of Lumax Industries Limited Q4, that concludes this conference. Thank you for joining us. You may now disconnect your lines.